All right. Hello, everybody. We are going to get started. I see still a couple people logging in, but I want to keep on time today. And our experts have a lot of information to share, so I don't want to get this past 1 o'clock. So we're going to keep moving. Thank you for joining us today. I am Carolyn Powell. I am your host today, and we'll be going through everything and getting it set up, and then I'll turn it over to our experts. So today's lunch presentation, hopefully you're in the right spot, is unlocking tax savings through cost segregations in 2025 and beyond. So if you're doing a construction project, either new construction or expansion of an existing building, or recently have done one, with the OBBB, there might be some tax savings for you. So our experts are going to go through that for you today, some strategies that you can apply, some savings, utilizing money then for some other initiatives or projects that you have coming up, and how to do that. So quick housekeeping, just want to point out a couple things. There is a toolbar, it should be on the right-hand side of your screen. In there, you can get a copy of the slides and also a copy of the bios of our experts. There's also a section in there that you can submit questions at any time, so feel free to go ahead and do that. Right after the webinar ends, you will get an exit survey. If you could complete that for us, let us know how the webinar was, what other topics you would like to hear. If you'd like a one-on-one call or meeting with John or Mike, you can do it in there. And then this afternoon, I will send an email to you with a copy of the slides, but also a link to the recorded session. So if you want to go back and check anything, watch again, share it with a colleague, anything like that, you can do it. I will send that this afternoon. So let's get started. Our experts today are John and Mike. You've seen them before on this subject, so you should know them. Both are CPAs here at the firm. John's been in public accounting for over 20 years and broad range of industries, auto dealers, manufacturing, distributors, real estate. So that's why he's an expert on this topic of cost segregation. And Mike Zeoli, he's been in public accounting for over 10 years. His industry is very similar, the manufacturing, wholesale, retail, construction, healthcare, real estate. So again, why he is your expert. So before I get started, I want to give our experts a little bit more information about you. So we're going to just do a quick poll. Flip over to it and then launch it. So hopefully you can see the poll. The question is, where are you at with your construction project? So if you want to fill that in. John, what do you think this one? Where do you think people are going to be?
Oh boy, I don't know. Probably completing it now.
Okay. All right. Let's see where they come in at. Give everybody another minute. I can see everybody's voting. All right, I'm gonna just to keep things moving, I'm gonna go quick with these polls for you guys. I shut it off and let's share the results. All right, 50% are starting in the next 12 months, so perfect timing for them to be watching this and learning a little bit more. Some have completed it already and some are thinking about it. And I'm gonna do a quick I have question. So the next question is, I have, and a couple different answers. Mike, where do you think this group is going to be this time around? Have they done it before? They have no idea what they're doing. They don't even know where they are right now.
I think we're going to go with have heard of it, but want to learn more.
All right. Let's see. Everybody's busy voting. Okay, I'm gonna close it in 3, 2, 1. Share real quick. 40% have done it in the past. Great. So they're just gonna get the new tips on how OBB is impacting it, but we have some others that plan to do one, never heard of it before. So we'll educate some new people to this. So I am going to jump off, let the experts do what they do. And John, I'm going to hand it over to you.
Thank you, Carolyn. Welcome everybody to our presentation today on unlocking tax savings through cost segregation. I'm going to start off with an overview of the agenda and really highlight several concepts that Mike and I will be talking about. First, we're going to explain what a cost segregation is and discuss the related tax benefits that a taxpayer can expect. We're going to identify tax issues that should be considered in conjunction with the cost segregation study. This is important because sometimes a cost segregation can yield significant benefits, and in other situations, it may not. So understanding if they do or they do not is very important to set your expectations before going through a cost segregation study. We're going to identify the most common qualifying assets applicable to cost segregation studies. We're going to go ahead and discuss tax law changes involving bonus depreciation and Section 179 depreciation. These are two provisions in the tax law that allow you to expense the dollars that you spend on a construction project in a very quick manner. We're also going to talk briefly about some estate planning considerations, and if time permits, we're going to get into the tangible property regulations. So with that, I'm going to hand it over to Mike, and we're going to get started.
Thanks, John. Okay, so default treatment of 39 years for commercial property. And further, it can be used to establish a unit of property under the tangible property regulations. Continuing on, the most advantageous time for a study is after new construction of a commercial or residential piece of property, but also can be beneficial with an acquisition of a property, a remodeling project within a property, or expanding upon an existing property. So next I'll move into an example of commercial office building. Let's assume $10 million new construction of commercial office space. So without a cost segregation, you can see costs are depreciated over 39 years in the first column in the depreciation comparison table there. You've got the entire $10 million in the 39-year bucket, which yields a year one depreciation deduction of roughly $250,000. With a cost seg study, just using the typical average reallocation that you'll see. So we've got about $2.5 million into the 5, 7, and 15-year asset classes. So assuming the construction has been completed post January 19th, 2025, it would qualify for 100% bonus depreciation. And that would yield a year one benefit of roughly $550,000, or year one depreciation of about 2.7 million versus the 250,000. So next I'll touch on a couple different property types that you typically see eligible for a cost seg study. You've got your apartment buildings, retail stores, restaurants, office buildings, manufacturing facilities, grocery stores, hotels, warehousing, distribution, storage facilities, and auto dealerships. Now this isn't all encompassing, that there's other building types that would be eligible, but these are some of the most common. And if you look, you'll see, for example, manufacturing facilities, that range is much higher than some of the others, and that's due to special types of electrical or reinforced concrete to support heavy-duty manufacturing equipment. There might be special lighting within the facility. So that's why you'll see the average reallocation of that, higher than what you'd see in a warehouse or distribution facility. So now on to some tax considerations. So bonus and Section 179 depreciation may apply to reallocated costs from the study, which is really what magnifies the tax benefit in the early couple of years after construction. You've got your unused tax deductions are going to carry forward to future years until they're ultimately utilized. Depreciation recapture, that will apply to personal property in the year of sale. So it's important to note if there's intent to sell the building within a few years after construction, there may not be as great of a benefit due to the depreciation recapture at ordinary income rates. Section 1031 like-kind exchange rules, they should be considered, can still be beneficial. However, bonus depreciation only applies to the excess basis in new property. And lastly, passive activity rules, which John is going to touch on, can prevent a taxpayer from receiving the full benefits of a cost seg study. Next, we'll touch on some planning considerations. So this is a widely used tax planning tool for real estate professionals and investors. The study is typically performed in the year construction is complete or the property is acquired. However, if you realize that you were eligible for a study and it's 3 to 4 years down the road, you still have the opportunity to go back in time and claim the unclaimed depreciation via Section 481A adjustment by filing Form 3115. So it's not necessarily included on an amended return, which you can only go back 3 years to make that adjustment. So if you ever think it's potentially too late to have a study performed, that's not the case. You can always go back and change your accounting method to claim those unclaimed deductions. So the next couple slides, I'll get into really the nuts and bolts of the overall study. And our end goal is to get as much as possible into Section 1245 tangible personal property, which is going to be your 5 and 7 year assets. So some of the most common asset classes would be equipment, furniture and fixtures, appliances, decorative lighting, decorative millwork. So all those things are kind of customary items that you would see in 5 or 7 year category. However, beyond that, within a restaurant, for example, you might have special plumbing hookups and such for dishwashers, special electrical and gas lines that are dedicated for a specific oven or other type of kitchen equipment. So not only would that piece of equipment qualify as a 5 year asset, but all the electrical and gas hookups and everything else that and ordinarily would be part of the building unit of property in 39 years, since it's dedicated directly to the piece of equipment, you'd be able to accelerate those costs as well. Next, we'll touch on land improvements. So what these are, improvements directly to or added to land, whether or not they're 1245 or 1250 property, provided that they are depreciable costs. So some examples of that would be parking lots, sidewalks, roads, drainage systems, septic systems, sewers, fencing, landscaping, and swimming pools. So these are all examples of section 1250 real property that they fall under the 00.3 asset class, which are 15-year recovery period, and they are eligible for bonus depreciation. Next, we'll touch on the allocation of soft costs, which are basically everything other than the direct costs of construction. So within that, you'll have your architect fees, engineering fees, building permits, general conditions, contractor overhead costs, legal and accounting, project management. So these costs are all allocated directly to the main direct costs of the project on a pro rata basis. So you'll have all these soft costs allocated towards 5, 7, 15, 39 accordingly based on the allocation of direct costs. Should we pause to answer some questions?
We do have one coming in. I don't know if you can read it from where you're sitting.
Yeah.
If you want me to.
So if we are building a facility, are we able to deduct some soft costs that would remove those costs from the depreciable basis? Yeah, so the soft costs, assuming they're all part of the construction and absent those costs, you wouldn't be able to have the construction done. All those soft costs would be allocated amongst all your direct costs and added to the depreciable basis.
All right, hopefully we answered that for you. If it's, if you need anything else, pop another question in there. Thanks, Mike.
Okay, so next we'll get into bonus depreciation. And I'll touch on the changes under the One Big Beautiful Bill Act. So under the previous legislation, which is the Tax Cuts and Jobs Act of 2018, we had 100% bonus depreciation applied to all assets acquired and placed in service after September 27th, 2017, and before January 1st, 2023. So the phase out began in 2023. So the last couple of years, we've been dealing with a reduced amount of allowable bonus depreciation. Most recently in 2024, we were only allowed 60% bonus depreciation, which made things a little bit more difficult overall to kind of project, potential tax benefits. Moving forward, under the new legislation, which was passed earlier this summer, we've got the permanent restoration of 100% bonus depreciation for qualified assets acquired and placed in service after January 19th, 2025. This supersedes the previous phase out schedule that began in 2023 under the TCJA. And 100% bonus is available for both new and used assets with a useful tax life of 20 years or less. Next, I'll touch on a new category of bonus depreciation allowed under the One Big Beautiful Bill Act. That is qualified production property. So this is a temporary category eligible for 100% expensing under the new code section 168N. So QPP includes portions of non-residential real property used in US manufacturing or production facilities. So some of the eligibility criteria kind of goes hand in hand with the other categories of bonus, special allowance. So you've got, must be non-residential real property, property must be used by a taxpayer as an integral part of a qualified production activity. I'll go into a little detail on what exactly that is. Must be located in the US and originally used by the taxpayer or meet certain exceptions of unused acquired property. Construction must begin between January 20th, 2025 and December 31st, 2028. And finally, it must be placed in service after July 4th, 2025 and prior to January 1st, 2031. So what is a qualified production activity? So what this is it involves manufacturing, producing, or refining tangible personal property, resulting in a substantial transformation to that property. So it must fundamentally change the nature of a product. So some examples of this would be fabricating raw steel into a finished product, which you would have raw steel if you're fabricating that into a car chassis. That would be a good example of a qualifying activity. Baking raw ingredients into a cookie or a pastry. That's substantially transforming the goods that you're baking into a finished product. Some non-qualifying activities, simply attaching a handle to an imported knife would not be a qualifying activity. Same thing with packaging or relabeling imported parts. That's not going to qualify. Lastly, some other considerations with qualified production property. In order to claim the 100% deduction, taxpayers must elect QPP expensing for each year it is claimed with the taxpayer's return for the year it goes into service. Portions of the building used for administrative functions, sales activities do not qualify. Food and beverage prepared in the same building as a retail establishment in which they are sold do not qualify. So restaurants, coffee shops, bake shops, etc., would be good examples of this. Unfortunately, not qualified production property. Also, lease property is not eligible for the QPP deduction. Lastly, it can be subject to recapture if it's not used in a qualified production activity within 10 years from the date the property is first placed in service. Lastly, I'll touch on qualified improvement property, or QIP, which can be defined as any interior improvement made to a non-residential building after the building was first placed in service by any taxpayer. The improvement must be non-structural in nature, must not be an enlargement of the building, and elevators and escalators do not qualify. So basically, any interior improvement made to the building, regardless of what unit of property it relates to, as long as it's not structural or an enlargement of the building, you can depreciate that over 15 years, and it's eligible for bonus and Section 179 expense. Now I'll hand it over to John. We'll get into 179 expensing and the rest of our items.
Thanks, Mike. So Section 179, much like bonus depreciation, is a way of accelerating tax depreciation. This is something that has been around for quite some time. It started in 1958, and the deduction was only about $10,000 back then. Over the years, it has increased. In 2003, the total amount of Section 179 deductions available to a taxpayer was approximately $100,000. That was increased by the Tax Cuts and Jobs Act in 2017 to $1 million. And again, Section 179 allows a business to deduct all or a portion of qualifying purchases. The One Big Beautiful Bill increased the total deductions allowed to $2.5 million. And there is, and there always has been, a purchase limitation. So, you know, for the 2025 and going forward, it's going to start off at $4 million. So really what that means is if a taxpayer places more than $4 million of qualifying Section 179 property into service, the overall deduction of that $2.5 million is going to be reduced. It's going to be reduced dollar for dollar, the amount that you go over that limitation. And I will say, just on a side note here, I don't have very many clients that put $4 million of Section 179 qualified property into service, so I don't foresee this being an issue. These new rules apply to property placed in service in 2025. And then again, in general, Section 179 applies to tangible personal property, such as machinery and equipment, furniture, and fixtures. Section 179 also applies to qualified real property. Qualified real property is a designation of property that has been around for quite some time. A few examples of qualified real property include roofs, HVAC systems, fire protection systems, and security systems. And similar to qualified improvement property, these are for improvements made to the property and must be made after the building is first placed in service. So essentially, you can't have essentially a new build, a new construction, or a new building and have qualified real property assets. And that's just to, it's for improvements to the property is essentially what it is. Next slide. So with everything we've talked about so far, we're going to go through a case study. And this case study is something that we did a couple of years ago. It was for a bar / restaurant / brewery. And this is really just for the building portion of that. There was an operating entity that actually owned a lot of the equipment, but this is really the building, the separate entity that owns the building. And that entity purchased an existing building. They made some renovations to the existing building, and then they expanded the footprint of the building to make another structure. So instead of depreciating everything over 39 years like you usually would do without a cost segregation, we were able to break out certain components of that work into lesser class lives. So in the new building, we were able to identify 5-year property. And as Mike mentioned earlier, this is for dedicated electrical work in the kitchen, the electrical work for the brewing equipment. You know, a lot of restaurants, they have special plumbing work that they need to run the restaurant equipment. There was decorative millwork and a lot of data and communication lines for, you know, TVs and surround sounds, things of that nature. We were able to segregate those costs out of the total $4 million paid. There was 15-year property as well, parking lots, sidewalks, curbing, any landscaping, and site drainage, things of that nature. We were able to take 15-year life on that. And you know, both of those, you know, were eligible for bonus depreciation. 5-year property was also eligible for Section 179 depreciation. Now, in the existing building, they did a lot of renovations. You know, so they tore down some walls, they put up new drywall, some new ceilings, they did some painting, kind of prettied up the building quite a bit. It was really for a banquet facility. So there were portions of the electrical, there was floorings, And all of that stuff qualified for qualified improvement properties. Again, improvements made that were non-structural to the building, were 15-year property, and they were eligible for bonus depreciation. 39-year qualified real property also came into play here because there were some improvements made to the existing roof, the HVAC system, and fire protection system as well. So as you can see on this next slide here, at the top of the slide, we show a total cost of a little over $4 million. And on the bottom part of the slide, we are showing what we can do with the cost segregation. We were able to break out 5-year property, 15-year property, qualified improvement property, and a qualified real property. And that was about $1.2 million of that $4 million. So this taxpayer made out pretty well here with the bonus depreciation and Section 179 depreciation to get that extra deduction in year one. This next slide just kind of summarizes the depreciation taken, the original depreciation, the updated depreciation by year, and it shows the tax savings by year. And you can see that, doing a cost segregation, there really is a savings from the time value of money, okay? And that was about $230,000 of real savings for the client. Now, as I mentioned in the agenda, there are certain issues that a taxpayer needs to consider when going through a cost segregation. And the first one that comes to mind is the passive activity rules, because in general, real estate is a passive activity. So passive activity loss rules generally limit the ability of taxpayers to shelter active trade or business income with the deductions from passive activities. So if you think about an individual taxpayer who has a salary of $100,000, and then he has a rental business, or he's got a couple of condos that he rents, and those generate a $30,000 loss in a year. Those $30,000 of passive losses cannot be used against the wage income that he received. Okay, passive losses can only be deducted against income from other passive activities. And if they're not deductible in a current year, they can be carried forward for future years until that taxpayer has passive income, or when the taxpayer disposes of his interest in that activity. Now, just because we have a passive activity doesn't necessarily mean we shouldn't do a cost segregation. In fact, we had one of our clients, I believe he constructed a medical building for about $7 million. He's not in the medical field, so this was certainly a passive activity for him. However, we did a cost segregation nonetheless and generated a tax deduction in year one of about $1.5 million. Now, he wasn't able to deduct any of that. However, for the past 7 years, that loss has been carried forward, so he hasn't been paying any tax on any of the rental income from that activity since we did the cost segregation. These carry forwards, they're tracked on a form on an individual tax return. It's the 8582. And again, I guess the key takeaway here is really just to plan ahead and account for these passive activity rules, or at least address them and understand them so your expectations are met. There is a solution to this passive activity rule, and that's called a grouping election. Section 469 allows a taxpayer to make this grouping election to combine trade or business activities with passive activities, essentially making them what's called a one economic unit. And this allows the losses from passive activities to offset active income. And we see this a lot, actually. A lot of our clients have operating businesses, usually in an S corporation, and they own the building too in a separate legal entity. It's usually an LLC. And really from a legal purpose, we like to have the operating business and the rental business in separate entities, just in case something happens on the property. Some of the liability is going to be, I guess, contained into that one legal entity. But for, again, for legal entities, they're separate, but under these passive activity rules, the grouping elections, they're treated as one. Once the election is made, it's irrevocable. There are various tests that need to be looked at to determine if you do have a one economic unit. And, the biggest one that I see and is applicable to my clients is the extent of common control or common ownership. Essentially, if you have one individual that owns an operating business and he also owns the building that he rents to the operating entity, essentially he could have that building in the other entity for the same purpose, right? I mean, so there's no difference in that. So that would be one economic unit where the the passive losses or the losses from the rental could be used to offset the business income. And there's a couple other things here: similarity and differences of businesses, geographic location, and interdependencies on the two activities. There's other ways that you can get around the passive activity rules other than a grouping election. You could try to become active or be a material participant with 500 hours. There's significant participation activities where you actually group a bunch of activities to get to that 500 hours. And of course, there's a real estate professional exception. Another issue that Mike brought up earlier in the presentation was depreciation recapture. And again, upon the sale of a property, a taxpayer is required to recapture depreciation taken on Section 1245 tangible personal property. So this is really something that we need to consider before going through a cost segregation for our clients. We really need to understand what their plans are with the building. Are they going to hold on to this for a significant amount of time? Are they going to flip it after 2 years? Because honestly, if they flip it after 2 years, they're really not gaining too much. There might be some time value of money, but for a 1 or 2 year period, it may not necessarily be worth it. The recapture amount, again, this is for the depreciation that is taken, is going to be taxed at ordinary income rates. So if you think about it, you took a depreciation deduction and you used ordinary income tax rates. For the deduction, you're actually going to have to pay tax at ordinary income rates as well. The recapture is the lesser of the allowable depreciation or the total gain realized. One of the solutions to the depreciation recapture issue is, really just to, hold it to death. All right, never sell the property. And this, it sounds silly, but this is actually a planning consideration that a lot of clients do, because under current estate laws, your beneficiaries are going to get a step up in basis at the date of your death. So as a property owner owns and holds and depreciates the property, they're taking all of these deductions, and quite honestly, they could depreciate the cost basis down to zero. But when they die, essentially under the current rules, their beneficiaries are going to get a step up to full fair market value. There's no tax on the sale, and the beneficiaries will be able to, if they're renting it, use that higher fair market value or the stepped up value, to depreciate the asset going further. Okay, tangible property regulations. The tangible property regulations are something that you might want to consider using, before a cost segregation. Tangible property regulations have been effective since 2014. Okay, and they provided guidance on various things. In particular, what is a unit of property? What are capital expenditures? What do we do with the amounts paid to acquire or improve tangible property? They provided guidance on what to do with dispositions, when expenditures should be expensed, The most, applicable provision for the tangible property regulations when it comes to cost segregation is really knowing when to capitalize something versus expense it, right? If you can expense something, there's no need to capitalize it. And if you don't capitalize it, there's no reason to depreciate it, okay? So that was very important to understand what needs to be capitalized and what could be expensed. The tangible property regulations also provided guidance on what was a unit of property. And this has to do with not just buildings, but a large piece of equipment, perhaps a printing press or something of that nature. But when it comes to a building, buildings are much larger than most equipment. So the tangible property regulations also provided guidance on what's called building systems. Okay, so inside of the building, of course you have your walls and you have your ceiling and your floor, but you also have these other building systems known as the HVAC system or the plumbing system, the electrical system. Elevators and escalators have their own class as well. So when capitalizing costs, you need to determine if those costs, are a major betterment to the unit of property. And so when you have a building, the unit of property is essentially the electrical building system. So the rule that we use, the rule of thumb is the BAR test, BAR, betterment, adaptation, or restoration. So you would need to capitalize costs for a unit, the work done on a unit of property if it's a betterment. This is something bigger, better, stronger, more efficient. Is the work that you did make that unit of property bigger, better, stronger, more efficient? Is there an adaptation? Did you change the use of the unit of property? Was there a restoration? Okay, restoration, is essentially bringing something back from death, right? I mean, it's the unit of property is not usable, so we have to do a lot of work. So that stuff's going to be capitalized. You change a bowling alley into an auto dealership, that's an adaptation. So those things are going to be considered capitalizable items, okay? When you have the tangible property regulations also have various examples of things that are not capitalizable, okay? And we see a lot of this in practice here too. Rubber membranes are probably the biggest thing that I see most often. A lot of buildings, their roofs get old, they need to replace the rubber membrane, and they capitalize it, $300,000 for a new membrane on a 40,000 square foot facility. I know for financial statement purposes, that is material, and they need to capitalize that for audit purposes. But for tax purposes, it's really not a major betterment to the unit of property. That's a $300,000 write-off for tax purposes. Because when you think about it, you're not replacing the roof, right? You're replacing a component of the roof. The roof structure has the rubber membrane, it has the tar paper, it has the ballast, it has the insulation, it has the support system, and we're really only replacing one part of that building system. So that is something that you could actually write off for tax purposes. You see it a lot too with replacement of HVAC systems. If a building has 10 units outside and you replace 3 of them, maybe for audit purposes again, or book purposes, you want to capitalize them. For tax purposes, that is something that you can expense. If you replace 60% of your HVAC system, then that's really more material and you need to capitalize that. And of course, if you capitalize any of this stuff, that's when you have to determine, what type of property it is and how to depreciate it. Next thing I want to talk about real quick here is demolition considerations. When a building is demolished, the building basis must be capitalized as non-depreciable land. So cost segregations come in key here. Maybe you need to do a cost segregation before you demolish the property. That cost segregation is going to tell you what type of tangible personal property is in that building, because you could dispose of that tangible personal property prior to the demolition. And that's going to be a direct expense for you. Cost segregations also help out with partial dispositions. And essentially what a partial asset disposition is, that it allows a taxpayer to write off the remaining depreciable basis of items removed during a renovation project, in addition to actually depreciating the deductions on the replaced parts. We see this, I see this on my auto dealer clients every so often, where the manufacturer says, hey, we want you to update your customer lounge and you need to spend, $500,000 on this renovation. And 7 years later, they come back and say, well, we've changed our mind. We now want to see the tile that's gray. We want to see different chairs and different paintings. So a cost segregation is going to help you identify what of that old customer lounge that you can write off, because you don't want to just capitalize the new stuff, okay? Because then you'll be depreciating 2 customer lounges. So a cost segregation is going to help you identify what those old costs were and dispose of them through a partial asset disposition. And then a cost segregation is also going to help you with the new stuff. What is the new stuff that you're putting in there? Is it qualified improvement property? If it's not the customer lounge, is it qualified real property, or is it 5, 7, 15-year property? So cost segregation certainly help with partial asset dispositions. And again, you see these a lot with roof repairs or replacement lightings, replacing doors, and as I mentioned earlier, the HVAC system. So the next couple of slides really are, really just for your reference. These again came out many years ago to help people understand the tangible property regulations, how to know when to expense certain things like materials and supplies, going through the whole what's a unit of property, things of that nature. The next slide talks about improvements. Improvements to the buildings. Was it a major betterment? You need to capitalize it. If it wasn't, is it a restoration or an adaptation? And if any of those things are true, then you need to capitalize them. And a cost segregation is probably the best way for you to maximize your benefits of the cost that you spend on those improvements. If they don't meet the bar test, then again, you could deduct those as repair expenses.
And we'll save these 2 slides as a separate document for everybody when I send out the email this afternoon, so that way if they want to zoom in a little bit further.
Okay, very good.
This, they'll have it.
So now we just have some, frequently asked questions. A lot of people wonder, what's a typical time frame for a cost segregation? And it really depends. I mean, we could usually get them done in, sometimes less than 30 days, but in general, 30 to 60 days. It's important to keep in mind your tax deadlines. If your tax return is due March 15th, probably not a good idea to wait till, March 10th to do a cost segregation. And again, this is all proper planning. It's more important for you to get the planning done well ahead of time. How much do I need to spend for a cost segregation? We really say like $750,000 is a good threshold. And, but that could also be lighter as well. If you spend less than that, we also offer a light version of the cost segregation.
And that's kind of a similar number that we see, John, when people go for the IDA benefits and their programs is kind of that 750 threshold. So if you're going for IDA assistance, this easily goes hand in hand with that. So
yep,
perfect. Don't forget, everybody, throw a question in the question section as we are going to just finish wrapping up with our experts. But if you have a question, definitely ask them. Use this time. While you're putting your questions in there, I'm going to run one last poll based on what you learned today. How are you feeling? Just to kind of see where everybody's at. Let me fill that out. Did have one question, John, come in. You talked about doors and windows and, different roof repairs, things like that. If somebody's a warehouse, has a large warehouse facility and is doing all new roll-up doors, where do those fit in?
Well, doors are part of the building, the exterior part of the building. So in general, it's going to be 39 years for that property. But again, did they have old doors on the building, right? So if you replace, potentially, well, if you let's think about it. If you take a step back. If you want to look at the tangible property regulations, you might be able to expense certain things like that. Just like I said with the windows, like if it's not a major betterment. If you replace 30% of your windows or maybe 30% of your doors, then you might be able to say that it's not really a major betterment to the unit of property, which is the building. But if you're replacing all of them, like the question said, chances are that that is greater than 50% and would need to be capitalized. And it's not QRP, right? It's not QIP, right? Because it's not interior. So it'd be 39 years.
Okay. Great.
So to that point, as a planning point here, if you have 10 doors, replace 3 this year and 3 next year, and if you can wait till the following year, replace 3 that way. So if you spread it out, you could seriously take the position that I'm going to expense them as they go.
Great. Interesting. Thank you. All right. I'm just going to close out this poll to share some more information and kind of get to these questions. And I'll share it real quick because it looks like 64% of our people are on track with their current project, but a couple people do need some more information, so we will touch base with you and see how we can help you. Like I said, throw questions in and we'll get those answered for you. Just wanted to let you know of some upcoming webinars that we have coming. We have a whole series on planning with purpose. That is going to be a 4-part series, and mixed in there, just so you see, November 13th for the manufacturers that are on with us today, we have Conquering Manufacturing Tax, Real World Lessons, and AI-driven trends in compliance. So for the manufacturers on this call, that's one you want to join. And for everybody, join the 4-part series that will be starting on November 2nd. Here's the contact information for our experts. You can reach out to them directly. They're more than happy to set up a meeting or call with you or Teams call for your specific project and questions. You can view our past webinar recordings, follow us on LinkedIn so you see our other events. And I think we are out of time today, guys. We want to thank everybody for joining us. And we will see you again at the next one. Have a good day.
Thank you.
Thanks, everyone.